Okay, folks, welcome back. This is going to be a lesson on algorithmic order flow and specifically dealing with changes in the state of delivery. All right, so I'm going to introduce the hierarchy to algorithmic order flow, and it will start with macro interest rate. Now, this is going to be looking at global interest rates, strongest against the weakest. This is saying basically pairing up the strongest versus the weakest or vice versa for your pairs, and or looking at carry trade ideas or opposing theory that would be against the normal expectation. In other words, there's sometimes, like we've seen in 2020, where euro is lower in its rate, or was it lower in its rate against the dollar, and euro rallied against the dollar. So that macro interest rate topic can be divided into subtopics, but it's beyond the scope of this lecture. The second is seasonal tendency. Third is buy or sell programs. Short-term bias. And finally, the state of delivery. Now, when you look at a marketplace and you break it down with this idea, this is generally what I'm doing when I'm looking at market price action. If I'm looking at an intraday chart, I'm using this as well. When I'm looking at a 5 and 1 minute chart, I'm considering this hierarchy as well. This hierarchy can be broken down modularly based upon the time frames, but I'm going to show you initially with a daily chart. And we'll drop down to a 4-hour chart to give you a greater appreciation for how this works with price. All right, so we have our euro-dollar chart zoomed in here. This is a daily, and I'm showing you a specific time when we had a bullish seasonal tendency. And I'll let you see that here. All right, so there's your seasonal tendency. Now I want you to look at the chart here and notice how between May and October, it has an unwillingness to go lower. Now, I'm not stating that there isn't declines. I'm stating that it's having a difficult time making lower lows. Okay, so you can see the low in May, then the low in July is higher, then the low in September is higher, and then finally everything starts to fall out of bed around October into November. So that time window is an area where if everything is underlyingly bullish, the euro dollar can see appreciation on the upside in the form of strong bullish prices. By itself, it doesn't have a whole lot of strength. But when we see things like what we saw this year with COVID and the economic impact that it had in the US, and the fact that our states and country basically is a consumer economy, and it's service oriented as well. So if there is a major shutdown in those types of things and imports coming in that we can't as Americans consume and buy, those are going to have a huge impact on our economy. And that is one of the reasons why the dollar has fallen so hard this year. The euro, despite its differential in its rate versus the dollar, would not seem appropriate to have a long-term hold. But we have to cancel out the effect of the interest rate market. And if there is an underlying bullishness that would override what would be reasonable. In other words, the expectation should be that euro should go lower against a stronger, not by much, but a stronger interest rate held by the greenback or dollar. But because of macroeconomic impacts of COVID, that more or less caused an override, okay, of the normalcy in the carry trade idea. So if we're looking at seasonal tendencies as the next in the hierarchy, it's enough if we can determine what it is we're trying to see as it relates to the interest rate market. And I'll touch more on this as we go into 2021, looking at interest rates and global interest rates compared to one another for the differentials, and how we can look at things that would cancel out the underlying narrative that would reasonably be expected like everyone else. I facetiously mentioned how the retail traders were on YouTube talking about how they would never want to sell euro dollar because of the differential between the dollar versus euro, and the dollar had a higher interest rate. So it's not always just that simple. There's some other things that you have to look at, and that's why having mentorship and having someone with having as many years of experience looking at and analyzing the markets like I have, it has a little bit of an advantage. Okay, so that way you don't fall victim to what would otherwise be expected as the obvious. And sometimes the obvious is the very thing you want to fade in the marketplace, because if everybody's expecting it, it's probably not going to happen. Interest rates, if we can determine there is no effect like we've seen with COVID, then the normalcy is seeing the higher interest rate versus a lower interest rate lead to the upside. It doesn't happen, as a straight line, but as a general rule of thumb, it's usually the way to go. But there are things that will upset that as a normal. So we're looking at a little bit closer with the euro dollar daily chart. I'm zoomed in a little bit here, just highlighting again the May to October time period. Now, I can talk about this because we've been bullish this year with euro, and I outlined all this movement. Now, I can speak about this with confidence because you all were witnesses to me outlining this entire run up in euro. But there's some things in here that I didn't specifically cover as the reasons why behind the scenes I was saying what I was expecting to see in the euro. Now, this line here is that buy side liquidity pool I mentioned that we would probably be up there around Christmas time. Now, at this time of the recording, we're higher than this here, but the draw on liquidity was this level here initially. So we always have to see if there's market structure to support a continuation once a target or terminus is reached. But we can see the bullish seasonal tendency, and right in here we were looking for the likelihood of it trading higher. It ran down below this old low here, and we were studying that real time as it happened. So the buy side liquidity resting above this relative equal highs on the daily chart. Again, I drew your attention to that back in the early parts of 2020. And again, this is your breaker. And this is all daily chart derived. And 1, 2, 3, all consecutive candles. You have to incorporate that as your PD array. Now, you can refine it in certain instances, and again, that will be outside the scope of this lesson, but order block theory and breakers are an order block. The idea is we have to consider all consecutive candles that would make up one specific order block. And since we're looking at the daily chart, you have to incorporate all of these candles as the bullish breaker. So we have a low, high, lower low, sell side liquidity taken, and the market rallied back up. Notice the sensitivity here. Trades back lower, back down to the old low, whipped one more time below it, kept the low intact, and then we started to see an appreciation on the upside. So this level here is the low of the breaker and the high of the breaker. So we have a stage here with this scenario. In this area here, we would expect to see some more accumulation. It does not need to trade to the low of the breaker. It does not need to do that. We're going to take a look at this area in here with this context. So the buy program is that we are expecting price to trade from here up to this level here. And we want to study every single day when we look at euro, is this pair signaling or indicating that institutional order flow is in fact bullish. How do we do that? We look at up close candles. Are they being pierced effortlessly? Are they being traded through? That means if bearish order blocks are being broken to the upside, and specifically every down close candle that would be a bullish order block, is it supporting price and sending price higher? If we see those two signatures with what has already been outlined so far in this video, you have determined institutional order flow as bullish. You're within a buy program and you have a target, so you know where it should likely begin and where it likely will draw to. So between these two price points, you now have the narrative. Focus on that. So let's take a closer look at this. Now we have our focus on short-term bias. From the beginning of the buy program, we're looking at this area here running up into mean threshold, bearish order block, last up close candle, potential rejection block, and the old high. There's your premium arrays within this range. So you have to be mindful of that as it trades up into it, because it could have easily went through it, but you have to consider the likelihood that it may need to retrace, consolidate, or potentially reverse altogether. Nothing states that this move here to here is going to happen with the likelihood of it not failing. Okay, there's always a possibility of failing. That's why we have to have stop losses. Stop loss orders are there as our shield because our analysis may be wrong. But we have reduced the market down to a specific element in analysis where the short-term bias is derived as bullish. And once we have that, we can focus in on how the markets trade going into up close candles to the left, and are they finding support in down close candles. Every time we dipped back in, it supported more price advance on the upside with these down close candles. The market rallies up, and then we have consolidation. Small little retracement, then price resumes higher. Every down close candle is finding support. Up close candles are being broken. Down close candle here, extend that out in time. Is it breaking down close candles? No. It's finding support of them and breaking up close candles. So your institutional order flow is bullish. Every time we have a down close candle, anticipate price movement higher afterwards. We do not lose sight of to the goal or the terminus here for the trade idea. So the structure and stage that we framed for this movement is enough to start building in the expected outcomes for each level of the algorithmic order flow hierarchy. So we're looking at this area here as short-term bias, and it's being bullish. While you have a short-term bullish bias, that means every single day you would go in looking for reasons to be a buyer. Now here's the thing. I want you to look at how many times we had down close candles and how many times we had up close candles. And also notice how much downside was offered with down close candles on the daily chart versus the up close candles on the daily candles. You have more magnitude on the upside. While you had potential to lose if you traded every single day and getting stopped out, that's fine. But look how many winning opportunities is offered once you strip the marketplace down to this in terms of short-term bias. But it has to be referred to in all levels of the hierarchy. Dropping down into the 4-hour chart, we're going to talk about the last level here, which is the state of delivery. In this area here, we have our first run on buy side liquidity over here. So the state of delivery is on buy side. So what does that mean? The candles are expanding on the upside with the expectation to run into levels of buy side liquidity. Now that might be sounding pretty obvious, and what's the big deal about that? It's important for you to start looking at how the market does this because there's going to be a change in the state of delivery. And I'll explain that now. We have an initial run up into an imbalance here. Then we drop with the state of delivery is now on the sell side. So it's expanding on the downside, but it's reaching for sell side liquidity. That would be resting below this swing low here and inside this buy side imbalance, sell side inefficiency. This would be institutional order flow entry drill or potentially consequent encroachment of this buy side imbalance, sell side inefficiency. When you have a change in the state of delivery, that means you have buy side, then it goes to sell side, but it's opposing your underlying direction, which would be up here. Okay, you're thinking later on at some undisclosed date in the future, price should be up here, okay, or at least drawing towards that direction. When we have a change in the state of delivery, that's when opportunity is born. Look at your PD array matrix. You have this entire price swing here, and we cut through candles. We're not supply and demand. What's over here? It's a bullish breaker. We have the low, the high, and the lower low. The last up close candle, and it's only one candle here, extended out in time. You can see the movement back down into that bullish breaker. And at the moment when the state of delivery has changed, but it's changed to an opposing state of what we would expect in our price run that we're anticipating running from the beginning of the buy program to the terminus. So we have a very high probability setup, but you're framing it on the context of where the state of delivery changes. We have buy side, which is in the direction of our trade. That's what we anticipate. But if we start seeing a run back down into sell side here, and then we have a bullish breaker, or it could have been an order block, or it could have been just a standard optimal trade entry, which alone, that's what this is here. You have a high probability setup forming on the basis of fleshing out algorithmic price delivery. So the order flow algorithmically is likely to see high probability setups with these signatures. All these factors coming in gives you this. Your institutional order flows, which you're trying to seek. You're trying to determine what that is. And it's the underlying direction of inflows at the institutional level orders. It is the highest probable direction of the delivery of price on the majority of near-term candles. That means once we have this here, between that and where you think IPTA will likely draw to, in other words, where's the draw on liquidity? That's what we have up here. Well, this was not just this one. We were looking for a potential run above those relative equal highs. So we have the breaker low. So we have a PD array here. Is it a surprise to see it stalling here and consolidating? No. This would be a level where it should do what? Accumulate more longs. And this is a 4-hour chart, so you can start seeing this whole fractal here. If you look at this area here on your own charts, and I'm going to counsel you to do that for your homework, this area in here with that bullish breaker low from the daily chart, you'll see this same type of fractal in here on lower time frame charts. So you can see the beginning of the move here, trading up to this level here, consolidating. We talked about how understanding when the market consolidates, and I would start teaching you how we can anticipate those times and periods. This is how you start to see these things. When you have a level reached, basically, as we have here, this is where we should see buying occur. But the market has already rallied up to that. But we shouldn't see any real retracements because it's underlyingly bullish, and we've already had a run in here, and we already had a run in here on the sell side. So it's not necessary for it to be here and then drop down into this level here. It could. There's always a likelihood of that happening, but it's not likely, or let's say it this way, it's most likely that it's just going to consolidate here versus retrace. Then the market rallies again. So every down close candle is supporting price on the upside, and every up close candle is being broken, showing you underlyingly bullish institutional order flow. IPTA will look to initiate significant price runs when the institutional order flow is directional and when the state of delivery has changed into opposing order flow at a key PD array. That's here. Then this is the other one where we consolidate. It doesn't look like much here because I'm showing you the entire price run here. But if you looked at this on a 15-minute time frame, this is, it's not a lot of movement in here. It's only like 40 pips of consolidation. And then it starts to run again. The main takeaway is I'm giving you the building blocks, the foundation to understanding when the market's going to consolidate, when it should expand. But when are these high probability setups going to form? Because if you don't know what the algorithm is likely to do, if you don't have some reference points of how the macros start operating and the delivery of price is initiated, then you will never understand how to read the tape. You won't know how to see the next setups form. You'll always be surprised or trying to catch up. This evolves over more lessons. Okay, so I'll talk more about this and we'll flesh this whole thing out a little bit more on the weekend edition lesson. Again, we're not talking about market analysis right now because it's during the holiday season, but I'll give you another level of this teaching here. We'll go deeper into it. And I'll also talk more about the state of delivery and what that means. And we'll talk specifically about the order blocks and how that works within the context of institutional order flow. But for now, just know that there is a specific hierarchy that we break down with algorithmic order flow. There isn't a lot of moving parts with algorithmic theory, but there is a lot of experience needed to see it and appreciate it. When you watch me work with 1 minute charts and I'm working intraday, buying and selling, buying and selling, and buying and selling, that all stems a lot from this. Okay, so understanding algorithmic theory, while I'm not teaching you every aspect of my personal algorithm, Enigma, I'm going to give you a lot of study points that'll help you grow in an understanding about how you can work with all time frames. I don't want you to feel like your model only works with the time frame that you like right now. The highest form of your analysis and the aptitude that you're striving for is seeing your model work on any time frame. And that gives you a lot of confidence and it gives you a lot of flexibility. You don't have a setup right now for swing trading? Okay, fine. Look for it on a short-term basis. You don't have it as a short-term trade? Okay, let's go into it as a day trade. Okay, maybe you missed the ideal scenario for the day trade entry. Well, let's go into the sessions and work the individual sessions. Okay, you missed the ideal entry for that particular session. All right, let's look at a scalp as an entry. Institutional order flow entry drill. Okay, that's your last weapon. It's not chasing price, but you're learning how to see opportunities, not chase them, and also be able to form fit your specific model. But you start with things like this that give you a foundation. And then it gives you a great deal of confidence because you watched me outline all this stuff. Like, I'm not talking about something in hindsight where it didn't happen. I'm giving you the flesh that was on the bone. Okay, you only seen me saying, okay, it's likely to go here, it's likely to go here, and kept stepping it up, stepping it up, stepping up. But the basis behind all of it was this. And it's always framed on things like this. When every time you see my examples, and I'm either showing off in the past in previous years and doing things on Twitter and such, there's a couple of videos I still have on my YouTube channel. The things I'm looking at is what I'm going to be teaching here. Now, it's not all of it, but you'll see by learning the things I'm going to cover before we close this month out, it'll give you a greater appreciation for why price does what it does and when it does. Okay? And it sounds like, what did you just say? It basically, until you see it, it won't really make sense. Okay? So just know that this is a foundational lesson, And we'll build on this when we go into this weekend's lesson, okay? And then next Wednesday, and then the following weekend, before we close the year out, I'll have another lesson that would go along with this particular series for daily routines and what we're looking for, okay? How we go through the process of breaking the charts down. What specifically are we looking for? When I say I'm looking at things algorithmically, this is what I'm referring to. This is the elements that I'm talking about. Now, there's some moving parts still that we have to cover, obviously, in charter level. But for now, I just want to give you all a little bit of foundational studies, because we will fastly be moving into that in charter content in 2021. So until I talk to you this weekend coming up, have yourself a very Merry Christmas, and